Welcome to International Securities Exchange's podcast series. Facilitated by renowned educators, ISE podcasts are intended to teach beginning as well as seasoned investors the ins and outs of trading. To find an updated list of podcasts, please visit www.ise.com/podcasts. Please be sure to listen to our important message following this episode regarding the risks of investing in exchange-traded options.
Now what I did was the implied volatility on the AUX at the time I put this trade on was about 35%. So what I did, I went out and I did a calculation and did a forecast that essentially said, okay, it's January 9th. I'm going to move ahead to January 20th, calculate the value of the March call if the volatility remains relatively the same, 35%. And the stock is at the price that it's at right now. How much would this call option be worth? Or essentially at 140. And so the two numbers that I have that are shown in gray there, 135.22 and 146.25, those are theoretical values. Those are approximate values of what my break-even prices would be. I don't know for sure what they'll be because I don't know how volatility might increase or decrease between now and then. It looks to me like probably volatility has dropped off a little bit since then. As Steve mentioned earlier, it's probably more in the 25% range, 24% range rather than 35. So those numbers are probably going to end up not being exactly right, but there's no way to know, so you just forecast. Now, if you have reason to believe the volatility is going to be increasing or decreasing, you can use those tools typically and adjust that volatility value and get maybe a more accurate forecast if it turns out that you were right. But essentially, those are the two numbers that I calculated that are approximately where I would break even as of January 20. Now, the second thing I want to do is calculate my longer-term break even. Now, the ideal scenario here is to have the short-term option expire worthless, and then you're left with just a long call option. And as most of you know, a long call option has an unlimited upside. So let's assume that the stock stays, or that the index stays below 140 by January expiration. It's at 139 and change. I'm going to be in the green zone. The 140 calls for Jan are going to expire worthless. Where does the stock need to go after that in order for me to break even? And the answer is it has to go up to about 145.5. And the reason it has to go there is because I've got a 140 call for March, and I've got to cover the cost of the original trade, which was 550. So I got to get up to 145.50, and that's basically just my strike price plus my net debit. If the stock's above 145.50 by the March expiration, I'll make money. Interestingly enough, that stock or that index is above 145.50 right now. In fact, it's at 151, so it's well above the expiration date for the long term. That doesn't necessarily mean I would have made money because I don't know where it was at on the January expiration. I think on the January expiration, this one was right around 148, and if my forecasted break-evens there of 140, 135, and 146 are roughly about right, I would have been in the red zone on the right as of the January expiration, because what happened on the AUX was that it actually shot up very sharply right after I did this trade. If you go to the chart on the AUX and you look at January 9 when I put this trade on, the AUX was at around 140.26. Within just about a week, it was already up to over 150. So it shot up very sharply. I was expecting a bullish move on it, but I didn't think, I was expecting the dollar to gain ground on the Australian dollar, but I didn't think it would gain ground that fast. Had I known it was going to gain ground that fast, a bullish vertical spread might have been a better trade. But in this example, you see my short-term direction is neutral to moderately bullish. Unfortunately, it was not neutral. It was not moderately bullish. It was actually very bullish. So I ended up shooting out past my green zone into my red zone to the right. Now, what I could have done at that point is I have a couple of choices. I can either close out my March 140 call at the value that it has at that time, which would be fairly high, and I can use that to offset the assignment that I'm going to incur on the January. And I could end up with a net, whatever the net differences between the two values of those options. I probably would have lost a little bit of money at that point if I had done that, because what would happen is the time value would be gone on the January, but it would be depleted sharply on the March because the March got well in the money. So it's very possible. It's pretty close. I would say we would have been really close up to the upper edge there where that green zone and the red zone meet on the right, maybe a little beyond that and into the red. Or I could potentially just close out my January 140s at a small loss, and if I waited because I was still bullish, and in this case that would have been a good call, that small loss that I took at that time would have added to my original net debit, and I would be maybe, let's say, maybe I'd be about $10 in the hole at this point. Well, if I held on to now, and let's just assume that let's say this index stays about where it's at for the rest of this week and closes out at 151, I'd end up maybe only making about $1. I would have made enough to get past the debit that I lost. But that's what's interesting about this strategy is you've got these two time frames. You got the first time frame and the second time frame. Once you get to the end of the first time frame, which is the Jan expiration, you have to decide on that at that point. What do you think about that currency pair again? What do you think about the dollar? Okay, it shot up faster than I expected it to. It put me into the red zone in the short term. Do I believe it still has continued upside? And if so, then I may want to close out that January at a loss and hold on to the March. If I don't think it has continued upside, maybe I want to just flatten out the whole spread, and maybe I break even, take a small loss, and I sit tight. You know, I've got a choice. I can do whatever I want with it. That's what's interesting about it. I think in this example, if you'd have held on to this, taking your hit on the Jan, by now you'd be profitable. It'd be a fairly small profit. I think you'd be up about $1 or so at this point. Next thing, yeah. You know what, Herb, I wasn't going to do any questions during the session, but I happened to see what you said, and it's a good point, so I'll bring it up. Another thing you can do, and I was going to talk about this a little earlier, but I'll go ahead and mention it now, is that if the January does expire, or if you end up buying back the January and closing it out, you can go ahead and sell a February as well. You've still got a calendar, only instead of having a 2-month calendar, you've now moved it down to a 1-month calendar. What's nice about that is that if you do take a hit on the January, the proceeds that you get by selling the February can offset a good chunk of that loss, and you can still stay bullish for the rest of the month. Thanks for bringing that up, Herb. I was going to mention it, but I'm glad you brought it up when you did. So you don't have to put these spreads on and assume that you have to hold them until expiration. You can close them out early. You can modify them by doing a second one. If I started out 6 months out on my long option and only 1 month on my short option, I might be able to sell 5 separate shorter-term options each month, and by the time I get to the expiration of my long option, I may well be to where my cost basis is down to almost nothing. So there are a lot of things you can do along the way, and what I like about options trading and spreads in particular is I like having the ability to sort of change the rules of the game as we go along. Our government, of course, does that to us every day, but we have the ability to control that in our own investments. All right, let's move on and look at a little bit more detail here. So my short-term maximum gain is going to be the value of my March call minus my debit. So I could potentially, if this stock was at exactly, or this underlying index was at exactly 140 at the January expiration, that's the price at which the stock will have hit that point at the top. In other words, the January option would be virtually worthless, and the March option would have its maximum value. And again, you can't calculate exactly what the value of that March call would be, but you can do an approximation using the pricing tool. If I assume that the volatility stays at about 35% and the index closes at exactly 140, the January expires, the value of the March 140 call would be approximately $236 in the money. In other words, it would be worth about $11.36 or so. So I would end up I could close it out and make $236 profit. Now, if the volatility dropped off a little as it did, it probably would have ended up being a little bit less than that. But the value of it would basically go up, and it would be worth $236 more than your net cost. So if I got into spread at a total cost of $550, I would be able to close out my Marches at $7.86. That would be the approximate value of the Marches if the stock was at 140 at the March expirations. It's at $8 now. It would drop down to $7.86, but because I had the January expire and my net debt was only $550, I'd end up with $236 left over. I hope that was clear.
Thank you for listening to our podcast. To find more podcasts on options, stocks, alternative markets, and market data, please visit www.ise.com/podcasts.